September 2007. Inside a Manhattan conference room, a Moody's managing director stands before his colleagues. The housing market is collapsing. Mortgage defaults are spiking, and he's about to admit something extraordinary. "We drank the Kool-Aid," he says. He's talking about the ratings, the AAA ratings. The same ratings that told the world these mortgage securities were as safe as U.S. Treasury bonds. The same ratings that his company handed out like candy. 30 mortgage securities every single working day in 2006 alone. Nearly 45,000 mortgage-related securities rated AAA between 2000 and 2007. By 2009, more than 5,000 of those securities would be downgraded to junk status. But here's what makes this crisis different from every other financial disaster. This wasn't about one rogue trader or one corrupt executive. This was about three companies, Moody's, Standard & Poor's, and Fitch, whose ratings were embedded into the very structure of our financial system. Pension funds couldn't buy investments without them. Banks couldn't set aside capital without them. The entire global market for mortgage-backed securities, worth over $3 trillion, couldn't exist without them. And they got it catastrophically wrong, not by accident, not because the crisis was impossible to predict, but because their business model required them to get it wrong. Between 2002 and 2007, revenues for these three firms doubled from $3 billion to over $6 billion. Moody's operating margins exceeded 50%, more profitable than ExxonMobil or Microsoft. For 5 consecutive years, Moody's had the highest profit margin of any company in the S&P 500. They were paid by the very companies whose securities they were rating. And when the music stopped, when housing prices finally fell, the ratings agencies didn't just fail to warn investors. Their mass downgrades through 2007 and 2008 accelerated the collapse, spreading panic across global markets. The Financial Crisis Inquiry Commission would later conclude that these failures were essential cogs in the wheel of financial destruction. This crisis could not have happened without them. This is the story of how 3 companies broke the trust of global markets, helped destroy trillions of dollars in wealth, and walked away virtually unscathed. To understand how the rating agencies became so powerful and so dangerous, you need to understand what a credit rating actually means. In theory, it's simple. A credit rating is supposed to tell you how likely it is that a borrower will pay back their debt. AAA means virtually no risk. BBB means moderate risk. Anything below BBB is considered junk, speculative, high-risk investments that could easily default. The rating scale uses letters. AAA is the highest. Standard & Poor's defines it as extremely strong capacity to meet financial commitments. Moody's uses AAA and calls it the highest quality subject to the lowest level of credit risk. Fitch says AAA denotes the lowest expectation of default risk. As of today, only 2 companies in the United States carry a AAA rating from these agencies, Microsoft and Johnson & Johnson. That's how rare it is. That's how exceptional you have to be to earn the highest grade. But between 2000 and 2007, Moody's alone rated nearly 45,000 mortgage-related securities as AAA. More than half of all structured finance securities they rated during that period received the same rating as Microsoft. In 2006, they approved 30 every working day. How did that happen? The power of credit rating agencies grew slowly over decades, then exploded in the 2000s. In 1975, the Securities and Exchange Commission created a special designation, the Nationally Recognized Statistical Rating Organization, or NRSRO. The SEC immediately grandfathered in 3 firms, Moody's, Standard & Poor's, and Fitch. Over the next 25 years, they designated only 4 additional firms. The big 3 dominated completely. Federal regulators built these ratings into the foundation of financial rules. Bank capital requirements were set based on ratings. Insurance companies' portfolios were regulated based on ratings. Money market funds were required by law to hold only highly rated securities. Pension funds could only buy investment-grade bonds, BBB or higher. The entire regulatory structure of American finance depended on these 3 companies getting it right. But here's the fatal flaw. Until the early 1970s, rating agencies were paid by investors who wanted independent analysis. Then the model flipped. The agencies started getting paid by the companies whose securities they were rating. This is called the issuer pays model, and it created an obvious conflict of interest. Imagine if restaurants paid food critics to review their establishments. Imagine if pharmaceutical companies paid the FDA to approve their drugs. That's essentially what was happening in the credit rating industry. And the money was extraordinary. According to internal documents, Moody's could earn as much as $250,000 to rate a single mortgage pool worth $350 million. Compare that to the $50,000 they earned rating a municipal bond of similar size. The profit margins were irresistible. In 2006, revenues from Moody's structured finance division accounted for 44% of all the company's sales. Between the time Moody's was spun off as a public company and February 2007, its stock price rose 340%. Wall Street loved them. Meanwhile, a new financial innovation was taking over the markets: securitization. The process had existed since the 1970s, when Freddie Mac and Fannie Mae created the first mortgage-backed securities. Banks would pool together thousands of mortgages and sell shares of that pool to investors. The homeowners' monthly payments would flow through to investors as returns. Then came the next evolution: collateralized debt obligations, or CDOs. Instead of everyone owning a slice of the whole pool, CDOs divided these mortgage pools into layers called tranches. The senior tranche got paid first, making it supposedly safer. The junior tranches carried more risk but promised higher returns. Between 2003 and 2007, Wall Street issued almost $700 billion in CDOs backed by mortgage securities. The global CDO market grew to over $1.5 trillion. In 2006 alone, the number of CDO tranches issued, 9,278, was nearly double the number issued in 2005. These were complex, opaque financial instruments. Few people truly understood how they worked, but they all carried one thing investors recognized: a rating. And here's what made CDOs so appealing to Wall Street. The rating agencies had a formula. If you pooled together enough BBB-rated mortgage tranches, the middle-tier, moderately risky stuff, and structured the CDO correctly, you could transform 70% of that pool into AAA-rated securities. It was financial alchemy. Low-grade material in, gold standard ratings out. Wall Street called it ratings arbitrage. Take securities that should be yielding 7 or 8% because of their risk, repackage them, get them rated AAA, and sell them at prices reserved for virtually risk-free investments. The profit margins were enormous, but it only worked if the rating agencies played along. And they did, enthusiastically. By 2006 and 2007, the collateral backing these CDOs had fundamentally changed. In the early 2000s, CDOs were diversified across many types of debt. By the peak of the bubble, they were dominated by subprime mortgages, loans to borrowers with bad credit, often with no down payment, sometimes with no documentation of income. These mortgages were being made to people who couldn't afford them, packaged into securities, stamped with AAA ratings, and sold to pension funds and investors around the world. Everyone involved, from mortgage brokers to Wall Street banks to rating agencies, was profiting from the boom. And as long as housing prices kept rising, the whole system appeared to work. But there were people who saw what was coming, analysts inside the rating agencies, regulators, investors, and their warnings were ignored because the machine just kept going. To understand why the rating agencies kept approving these toxic securities, you need to understand the competitive pressure they faced. And it came down to one brutal reality: if you didn't give the investment banks the ratings they wanted, they'd take their business elsewhere. This is called ratings shopping. An investment bank would approach multiple rating agencies with a proposed CDO structure. If Moody's said the models didn't support AAA rating, the bank would try Standard & Poor's. If S&P had concerns, they'd try Fitch. Eventually, someone would say yes. Research has shown that securities rated by only one agency were significantly more likely to be downgraded than securities rated by multiple agencies. Tranches rated by a single agency had a downgrade rate of almost 13%, compared to much lower rates for securities rated by 2 or 3 agencies. This suggests that when issuers could choose just one rater, they picked the most generous one. Inside the agencies, analysts knew what was happening. Internal emails and instant messages obtained by investigators reveal the culture. In one exchange, 2 Standard & Poor's analysts discussed a particularly poor quality deal. One wrote, "Let's hope we are all wealthy and retired by the time this house of cards falters." Another responded, "I'm more concerned about the fact that we rate every deal." At Moody's, an analyst wrote to a colleague, "These structures are crazy. We should not be rating them." But the deals kept coming and the ratings kept flowing. Former Moody's executive Jerome Fons, who testified before Congress, described the transformation of the company. When he joined Moody's in the 1990s, it operated with an academic culture, focused on getting ratings right. By the mid-2000s, that had changed. The focus shifted to market share and revenue growth. Analysts who questioned deals or resisted pressure were sidelined. The competition was fierce. In testimony before Congress, Moody's chairman Raymond McDaniel described what happened in 2004 and 2005. Our competition, Fitch and S&P, went nuts. Everything was investment grade. It didn't really matter. We tried to alert the market. We said, we're not rating it. This stuff isn't investment grade. No one cared because the machine just kept going. Think about what he's admitting there. Moody's executives knew, they knew, that securities were being rated investment grade that shouldn't be. They tried briefly to maintain standards, but when clients took their business to competitors who would give them the ratings they wanted, Moody's caved. They couldn't afford to lose market share. The agencies also replaced human judgment with mathematical models. These models were supposed to predict the probability of default based on historical data. But they had fatal flaws. First, they assumed housing prices would never decline nationwide. That had never happened in modern American history, so the models didn't account for it. What would happen if housing prices fell 10%, 20%? The model said it couldn't happen. Second, they assumed the mortgages in different geographic regions were uncorrelated, that a foreclosure wave in California wouldn't affect Florida or Nevada. This assumption allowed them to claim the risks were diversified. But when the bubble burst, foreclosures spiked everywhere simultaneously. Third, they didn't account for the deteriorating quality of mortgage underwriting. Between 2002 and 2007, approximately $3.2 trillion in loans were made to homeowners with bad credit and often undocumented incomes. These were subprime and Alt-A mortgages, loans that previous generations of bankers would never have approved. Many borrowers had silent seconds, hidden second mortgages that left them with zero equity in their homes. If prices fell even slightly, they'd owe more than the house was worth. They had every incentive to walk away. The models didn't capture this. Industry veteran Michael Lewis, who wrote about the crisis, explained that the models were riddled with opportunities for manipulation. Investment banks learned which assumptions the rating agencies used and structured their CDOs to exploit those assumptions. Find the loopholes, game the system, get the AAA rating, and the rating agencies had no incentive to fix the models. Every time they rated a security, they collected a fee. More ratings meant more revenue. Tougher standards meant fewer deals. Between 2000 and 2007, Moody's profits quadrupled. Their operating margins consistently exceeded 50%. The company was printing money. The banks issuing these securities were even more aggressive. They knew the mortgages were bad. They knew the structures were fragile. But they also knew they could sell anything with a AAA rating attached. Pension funds, insurance companies, foreign banks, everyone wanted yield, and AAA-rated securities seemed to offer high returns with minimal risk. In reality, many of these securities should have been rated junk, but that wouldn't sell. So the agencies bent their methodologies, adjusted their assumptions, and approved deal after deal. By 2006, warning signs were everywhere. Housing prices had risen to unsustainable levels. Mortgage defaults were beginning to tick up. Some hedge funds were already betting that the market would collapse, buying insurance through credit default swaps on mortgage securities. Janet Tavakoli, a structured finance expert, forecast in 2007 that subprime losses would reach approximately $300 billion, 6 times higher than Federal Reserve estimates. Her analysis was based on realistic assumptions about default rates and recovery values. She was dismissed as a pessimist. The agencies had all the data they needed. They saw the same loan level information. They knew about the stated income loans, the aggressive re-aging of mortgages by servicers, the falling recovery rates. But acknowledging those risks meant downgrading trillions of dollars in securities. It meant admitting they'd been wrong for years. It meant destroying their own business model. So they kept rating. 30 new AAA mortgage securities every working day in 2006. The profits rolled in, the stock prices soared, and the foundation of the global financial system became increasingly fragile. The only question was when it would crack. The first cracks appeared in early 2007. Housing prices, which had been climbing for years, began to flatten and then decline. Suddenly, the assumptions built into every rating model were being tested, and they were failing. Mortgage defaults started rising. Not slowly, not gradually, but sharply. Borrowers who'd been given mortgages with low teaser rates saw their payments jump when the rates reset. People who'd bought houses with no money down and no proof of income couldn't afford the payments. Foreclosures began spreading across the country. In February 2007, HSBC announced massive losses on its U.S. subprime mortgage portfolio. In April, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. By summer, Bear Stearns had to shut down 2 hedge funds that had invested heavily in mortgage-backed securities. The rating agencies initially tried to minimize the damage. They made selective downgrades, hitting the lower-rated tranches first while maintaining AAA ratings on the senior securities. They assured investors that the problems were contained to the subprime E market, that the diversification in their models would protect the higher-rated securities. But internally, panic was setting in. Moody's began a review of mortgage securities it had rated. The results were devastating. In July 2007, Moody's downgraded 83% of the $869 billion in mortgage securities it had rated STOSI AA just the previous year. Entire vintage years of securities, 2006, 2005, were being slashed to junk status. Standard & Poor's was forced to downgrade more than 2/3 of its investment-grade ratings. By the end of the crisis, they downgraded over 5,000 mortgage-backed securities. The downgrades created a vicious cycle. When a security lost its investment-grade rating, institutional investors were often required by their own rules to sell it immediately. This forced selling drove prices down further, triggering more downgrades, causing more forced selling. The market seized up completely. Investors who'd trusted that AAA ratings were facing catastrophic losses. A 2010 analysis found that by April of that year, 73% of all mortgage-backed securities Moody's had rated AAA in 2006 had been downgraded to junk. More than half of the AAA-rated CDOs issued between 2005 and 2007, over $300 billion worth, were either downgraded to junk or suffered principal losses. The Financial Crisis Inquiry Commission would later estimate that CDOs made up over half of the nearly $1 trillion in losses suffered by financial institutions from 2007 to early 2009. Some people had tried to raise the alarm before it was too late. Within the rating agencies themselves, analysts had expressed concerns. Frank Rader, a former executive at Standard & Poor's, testified to Congress about the pressure analysts faced. Deals had to be rated quickly to generate revenue. Questions were discouraged. Standards were relaxed to maintain market share. Outside the agencies, some investors and analysts had identified the problem. The hedge fund manager John Paulson made billions betting against subprime mortgages. Steve Eisman, another investor profiled in Michael Lewis's book The Big Short, recognized that the rating agencies were the weakest link in the entire system. If you understood how badly they were missing the risks, you could profit enormously from their failures. But for most investors, pension funds, municipal treasurers, foreign banks, the ratings were gospel. These were sophisticated institutions with professional managers, but they'd been taught to trust the ratings. Many investment charters required them to hold only AAA or AA securities. They had no choice but to rely on Moody's, S&P, and Fitch. The agency's response to criticism was always the same. Ratings are opinions. They're not recommendations. They're not guarantees. Read the disclaimers. We never told you to invest based solely on our ratings. But this defense ignored reality. The ratings weren't just opinions. They were embedded in regulations, in investment guidelines, in risk models across the financial system. Banks' capital requirements depended on them. Insurance companies' reserve calculations depended on them. The entire structured finance market existed because of them. By fall 2007, the broader market was beginning to realize how bad things were. Liquidity was drying up. Banks were suddenly unwilling to lend to each other, unsure which institutions had exposure to toxic mortgage securities. The commercial paper market, where companies go for short-term funding, was freezing. In November 2007 alone, rating agencies made 2,000 downgrades. 500 tranches were downgraded more than 10 notches, from investment grade straight down to junk in a single action. Each downgrade announcement sent shockwaves through the markets. Investment banks that had held these securities as supposedly safe collateral suddenly couldn't use them to borrow money. Hedge funds faced margin calls. Everyone was trying to figure out how much of this toxic debt is in our portfolios, how much is in our counterparties' portfolios. The rating agencies had created the boom with their overly generous ratings. Now their frantic downgrades were accelerating the bust, and the worst was yet to come. March 2008, Bear Stearns, one of Wall Street's most prestigious investment banks, collapsed in 48 hours. The Federal Reserve orchestrated an emergency sale to J.P. Morgan Chase to prevent complete failure. Bear's exposure to mortgage-backed securities and CDOs, those AAA-rated instruments, had destroyed the firm. But this was just the beginning. Throughout spring and summer 2008, the rating agencies continued their mass downgrades. Securities that had been rated AAA months earlier were now rated B or lower. Investors who thought they were holding safe assets discovered they owned junk. The losses mounted. Then came September 2008, the month that changed everything. September 7th, the government seized control of Fannie Mae and Freddie Mac, the mortgage giants that had guaranteed trillions in mortgages. They were on the brink of collapse. September 15th, Lehman Brothers filed for bankruptcy. The fourth largest investment bank in America, with over $600 billion in assets, was gone. The entire financial system shuttered. Credit markets froze completely. Banks stopped lending to anyone. September 16th, the Federal Reserve bailed out AIG, the insurance giant, with $85 billion. AIG had sold insurance, credit default swaps, on hundreds of billions of dollars in mortgage securities. Many of those securities had carried AAA ratings. When the ratings collapsed, AIG's exposure was catastrophic. Without government intervention, AIG would have failed, potentially taking down dozens of other institutions. The following days saw Bank of America acquire Merrill Lynch in an emergency deal. Goldman Sachs and Morgan Stanley, the last two independent investment banks, converted to bank holding companies to access Federal Reserve support. Washington Mutual failed in the largest bank failure in American history. The global financial system was in freefall. Stock markets plummeted. Credit markets were paralyzed. The real economy was cratering as businesses couldn't get loans. Consumers stopped spending and unemployment began spiking. And throughout this collapse, one thing was clear. The AAA ratings had been a lie. The rating agencies tried to defend themselves. In October 2008, the CEOs of Moody's, Standard & Poor's, and Fitch testified before Congress. Their message: virtually no one could have anticipated what occurred. This was an unprecedented event, a perfect storm, a once-in-a-century crisis. But members of Congress weren't buying it. Representative Henry Waxman, who chaired the hearing, had obtained internal documents from the rating agencies, emails, instant messages, internal presentations, and they told a very different story. One Moody's analyst wrote, "We rate every deal. It could be structured by cows and we would rate it." At Standard & Poor's, an analyst complained in an email, "We should not be rating it. It's basically faking our way through it." Another wrote, "Lord help our fucking scam. This has to be the stupidest place I have ever worked at." These weren't rogue employees. These were the people doing the actual analysis, watching their companies approve securities they knew were fundamentally flawed. The congressional testimony revealed that the rating agencies had been aware of deteriorating mortgage quality for years. They'd received warnings from their own analysts. They'd seen data showing rising defaults, but they'd done nothing. The fees were too lucrative. The competitive pressure was too intense. The market share was too valuable. Representative Waxman summarized it brutally. "The story of the credit rating agencies is a story of colossal failure. You claimed your ratings were independent and objective, but they were driven by the pressure for market share and revenue. The human cost was staggering. By 2009, more than 8 million Americans had lost their jobs. The unemployment rate hit 10%. 4 million families had lost their homes to foreclosure, with another 4.5 million behind on payments or in the foreclosure process. Nearly $11 trillion in household wealth vanished. Retirement accounts were decimated, life savings disappeared, businesses closed, communities were devastated. And it wasn't just America. These AAA-rated securities had been sold around the world. European banks held hundreds of billions in toxic American mortgage securities. Iceland's banking system collapsed. Ireland needed a bailout. The crisis spread globally, triggering what would become the Great Recession. The rating agency's role was central to all of it. As the Financial Crisis Inquiry Commission would later state, this crisis could not have happened without the rating agencies. Their ratings helped the market soar, and their downgrades through 2007 and 2008 wreaked havoc across markets and firms. The Commission examined Moody's as a case study and found systematic failures. Between 2000 and 2007, Moody's had rated nearly 45,000 mortgage-related securities as AAA. By the end of 2009, over half of the CDOs by value issued from 2005 to 2007 that rating agencies gave AAA ratings were impaired, written down to junk or suffering principal losses. Think about that. More than half. These weren't marginal mistakes. These weren't securities that just barely missed the mark. These were securities rated as virtually risk-free that turned out to be nearly worthless. The agencies claimed their models failed because no one predicted a nationwide decline in housing prices. But that wasn't true. Many analysts, including some inside the rating agencies, had warned about the bubble. The problem wasn't lack of information. The problem was that acknowledging the risk would have required tougher standards, fewer ratings, and lower profits. Former Federal Reserve Chairman Paul Volcker would later complain that no meaningful reform of credit rating agencies had been undertaken even after the crisis. The fundamental conflicts of interest remained. The issuer pays model remained. The same three companies still dominated the industry. By 2011, when the Financial Crisis Inquiry Commission released its final report, the scale of the disaster was clear. But the report also made clear something else. This wasn't an accident. This wasn't an unforeseeable catastrophe. This was the predictable result of a broken system where profit mattered more than accuracy, where competition led to a race to the bottom, and where the guardians of market integrity failed completely. The rating agencies had been essential cogs in the wheel of financial destruction. They'd enabled the crisis, profited from it, and then accelerated the collapse with their mass downgrades. And the question everyone was asking, would anyone be held accountable? In the immediate aftermath of the crisis, many people assumed the rating agencies would face serious consequences. After all, their failures had contributed to the worst financial crisis since the Great Depression. Surely there would be prosecutions, massive fines, fundamental reforms. The reality was far less dramatic. The rating agencies had a powerful legal defense. Their ratings were protected as free speech under the First Amendment. They were opinions, not facts. They couldn't be held liable for getting it wrong, any more than a movie critic could be sued for giving a bad review. Courts largely accepted this argument. Early lawsuits against the agencies were dismissed. Even when plaintiffs could show they'd relied on the ratings and suffered massive losses, judges ruled that the ratings were opinions protected by the Constitution. But eventually, some accountability came, though it took years. In February 2013, the Justice Department filed a lawsuit against Standard & Poor's, seeking $5 billion in damages. The government alleged that S&P had knowingly issued inflated ratings on mortgage-backed securities and CDOs before the crisis, defrauding investors. The case revealed damning internal evidence. Emails showing S&P analysts admitting they were faking their way through ratings, documents showing the company had altered its models to increase market share rather than improve accuracy. testimony indicating executives knew the ratings were wrong but approved them anyway. In February 2015, S&P settled for $1.5 billion, $1.375 billion to the Justice Department, and additional amounts to state attorneys general. It was one of the largest settlements against a financial services firm related to the crisis. S&P didn't admit wrongdoing, but the settlement acknowledged they'd failed to follow their own standards. Moody's faced similar pressure. In January 2017, Moody's agreed to pay nearly $864 million to settle with the Justice Department, 21 states, and the District of Columbia. The allegations were similar. Moody's had inflated ratings on risky mortgage-backed securities and CDOs from 2004 to 2007, prioritizing market share and profit over accuracy. In 2019, Moody's paid another $130 million to settle with a California pension fund over allegations that it had misrepresented the risks of structured financial products. Fitch escaped with smaller penalties, but faced its own investigations and settlements. These were significant sums. But compare them to the scale of the damage. Trillions of dollars in losses across the global economy, millions of jobs lost, millions of homes foreclosed, and the rating agencies paid, collectively, less than $3 billion. For context, Moody's 2006 revenue alone was over $2 billion. The settlements were essentially a few years of profit from the boom times. The companies remained intact, remained dominant in the market, and continued operating under essentially the same business model. Some regulatory reforms were attempted. In 2006, Congress passed the Credit Rating Agency Reform Act, intended to increase competition by making it easier for new firms to become nationally recognized statistical rating organizations. The hope was that more competition would improve quality. It didn't work. By 2013, analysis showed that the Big Three still issued 97% of all credit ratings, down only 1% from before the crisis. The barriers to entry remained enormous. The established agencies had relationships, data, and regulatory acceptance that new competitors couldn't match. The Dodd-Frank Act of 2010 included provisions aimed at the rating agencies. It required them to disclose more information about their methodologies. It created an Office of Credit Ratings within the SEC to oversee them. It gave investors just new legal grounds to sue if they could prove the agencies failed to conduct reasonable investigations. But the fundamental conflict of interest, the issuer pays model, remained untouched. Rating agencies were still being paid by the companies whose securities they rated. The incentive structure that had driven the crisis was still in place. And here's the troubling part. The agencies continued making similar mistakes after the crisis. A 2019 Wall Street Journal analysis of approximately 30,000 ratings of structured securities issued between 2008 and 2019 found that the agencies still faced challenges with rating accuracy. They had underestimated risks in the subprime auto loan market, where lax underwriting standards mirrored the pre-crisis mortgage problems. They'd assigned AAA ratings to collateralized loan obligations that later had to be downgraded during the COVID-19 market turmoil in 2020. Research published in 2021 found that the agencies had shifted their motivation from revenue concerns before the crisis to safety concerns afterward, meaning they now herded together, following each other's ratings to ensure that if they were all wrong, no one agency would be singled out for blame. Some academics and industry experts argue the rating agencies have improved. They point to more conservative models, better disclosure, increased regulatory oversight. They note that mortgage-backed securities and CDOs performed much better in subsequent years. Others remain skeptical. They argue that the fundamental problem, paying raters to rate the products of those who pay them, guarantees conflicts of interest. As long as that model exists, they say, the incentives are skewed. Former Federal Reserve Chairman Paul Volcker was blunt in a 2013 article. No meaningful reform of the credit rating agencies has been undertaken. The rating agencies survived, their reputations were damaged, but their market position remained secure. They'd paid significant fines, but remained profitable. And most importantly, they remained embedded in the regulatory structure of global finance. The system that failed so catastrophically was largely still in place. So what does this tell us about our financial system? What lessons should we take from the rating agencies' spectacular failure? First, conflicts of interest matter. When you pay someone to evaluate your product, you compromise their objectivity. This isn't a theoretical problem, it's a practical reality that led to catastrophic consequences. The issuer pays model created perverse incentives that overwhelm professional judgment and institutional integrity. Second, complexity can be weaponized. The rating agencies' mathematical models weren't just technical tools, they were shields. When analysts raised concerns, they were told the models said it was fine. When investors asked questions, they were shown sophisticated risk calculations. The complexity created an illusion of precision and masked fundamental weaknesses. Third, market concentration is dangerous. When three companies control 97% of a critical market, competition doesn't improve quality. It creates a race to the bottom. If Moody's won't give you the rating you want, try S&P. If S&P says no, try Fitch. Someone will say yes. And once one agency approves a deal, the others have to follow or lose market share. Fourth, regulatory capture is real. The rating agencies were supposed to be supervised by the SEC, but the agencies had become so powerful, so embedded in the financial system, that meaningful oversight was nearly impossible. They weren't just being regulated, they were part of the regulatory structure itself. Fifth, accountability is elusive. Despite the damage, despite the clear evidence of failures, the consequences were limited. Some fines, some settlements, but no fundamental restructuring. The agencies survived because the system needed them. Too much regulation depended on their ratings. Too many institutions relied on their assessments. They were, in a sense, too important to truly punish. And finally, this question, are we still vulnerable? The answer is yes. The rating agencies still operate under the issuer pays model. They still dominate the market. Their ratings are still embedded in regulations and investment guidelines worldwide. The structures that failed in 2008 remain largely intact. Since the crisis, we've seen the agencies repeat similar mistakes in other markets. Corporate debt, emerging market bonds, structured products beyond mortgages. Each time the pattern is similar: optimistic assumptions, generous ratings, eventual downgrades when reality hits. Some argue we should eliminate the regulatory reliance on ratings, forcing investors to do their own analysis. Others propose government-funded rating agencies to eliminate conflicts of interest. Some suggest requiring agencies to have skin in the game, making them liable for losses when their ratings prove wrong. But none of these reforms have been implemented. The political will doesn't exist. The industry's lobbying power is formidable, and perhaps most importantly, no one has figured out a replacement system that would work better. So we're left with the same agencies, the same model, the same vulnerabilities, and the same question, when will it happen again? The story of the credit rating agencies isn't just about one crisis or one set of mistakes. It's about how trust becomes currency in financial markets and what happens when that trust is betrayed. Between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities as AAA. By 2009, more than 5,000 of those securities had been downgraded to junk. The agencies had claimed these investments were as safe as U.S. Treasury bonds. They were wrong. Catastrophically wrong. The cost was measured in trillions of dollars lost, millions of jobs destroyed, millions of families who lost their homes. And the three companies that enabled it all walked away largely intact, still dominant in the same market, still operating under the same flawed model. The next time you hear about a financial product with a AAA rating, remember this story. Remember that those three letters aren't a guarantee. They're an opinion that, in 2008, proved to be worth absolutely nothing. If you want to understand how the next financial crisis will happen, pay attention to where complexity meets conflicts of interest. Pay attention to who's getting paid to tell you something is safe. And ask yourself, have we really learned anything? Thanks for watching Corruption Rewind. If this story opened your eyes to how broken our financial system really is, hit that subscribe button. We expose the corruption, greed, and systemic failures that cost ordinary people everything while the powerful walk away untouched. Next up, we're diving into the executives who crashed the economy and got million-dollar bonuses instead of prison sentences. You won't believe what they're doing now. Drop a comment and tell me, should the rating agencies still exist? Or is it time to burn this whole system down and start over? See you in the next investigation.